Unit 4, we're going to look at the securities market. So securities market is basically summarized as follows. We divide the securities market into two. We have what we call the primary and the secondary market. So in the primary market, basically, this is a market where we issue new shares to the investors for the first time. So it is a market where companies and government and other entities will fresh up their capital. However, the existing of an efficient secondary market is important for the primary market to be complemented. So this is because the secondary market will provide liquidity, which is the ability for investors to easily buy and sell their shares after they have been issued. So liquidity is an important aspect in the financial market where investors will be able to access funds for investment. So without liquidity, investors would be hesitant to purchase new shares, knowing that they might be unable to sell them quickly. So we have what is called a secondary market, which is made up of several distinct characteristics or segments. So the secondary market has a number of features. Okay, it has distinct segments. So each of the segments in secondary market um, offers different trading platforms and features. So we have what we call the listed exchanges in the secondary market. So these segments that we're talking about here, just expand. We have what we call the listed exchanges. So the listed exchanges are important to know, like the Lusaka Stock Exchange, the New York, um, the American Stock Exchange, the Toronto Stock Exchange. So the listed exchanges are major stock exchanges that allow various regional exchanges to take place. They will provide us with centralized avenues for trading securities to meet specific listing requirements. So we also have what we call over-the-counter. Also have what we call over-the-counter markets. So these over-the-counter markets are also important to know because in investment, they are in decentralized markets that involve the trading of securities directly between parties and often can be facilitated by dealers. So in the over or OTC markets, there are securities that are not listed in the formal exchanges. So individuals can access these markets to a broader range of investments, including smaller or newer companies. We also have what are called the third uh, markets. Okay, third market. What is a third market in investment? Third market. If you ever heard of that term, it's simply one which involves trading of exchange listed securities over the counter market. Typically, these ones are usually run by institutional investors. It will allow for large transactions to be executed outside the traditional exchange environment. So this third market is often more favorable where there's favorable pricing, there's less market impact. And then lastly, but not the least, we have what we call the fourth market. That's what we call the fourth market. It's another important um, market that you need to know. Fourth market. What happens in the fourth market? Fourth market, it involves direct trading between large institutions without the use of brokers, without the use of exchanges. So often, trade is conducted through electronic communication networks. They offer privacy and they are low transaction costs and also reduce spreads in this kind of market. So as an investor, you will likely want to diversify your portfolio by investing across the secondary market segments. These are both within your home, country, or internationally. So if you want to do this effectively, it is important to understand how each of these markets and their structures are, the regulations, the costs, the liquidity, the accessibility, understanding how these markets operate. At the same time, you need to recognize their similarities. Okay, so over the past decades, the structures, the behaviors of these security markets have really undergone dramatic transformations. So these changes have been primarily affected by the rise of institutional trading. So let's delve into some of the important components that we questions below there. Okay, so I've talked about the segment of the secondary markets. I've talked about the listed exchanges, what they are. We've talked about the over-the-counter markets, what is involved in there. We've talked about the third market and also the fourth market. So if you want to invest in to understand the characteristics of each of these ones here. Is that clear? So we now go to understanding these questions here. But before we answer all of the questions, we will need to learn a bit of the components that we needed to know. Okay, so let's start with the characteristics of a market. Okay, characteristics of a goods market. So what is a market? It's a mechanism through which buyers and sellers will do what? Will conduct trade. We have different characteristics that will make up a market, which we're going to look at. So here are the characteristics and definition of a market. Number one, a market is simply a place or mechanism through which buyers and sellers will interact in the exchange of goods and services. So financial instruments can be exchanged in there. So in financial terms, the market is where securities like stocks and bonds are bought or sold. So here are some of the characteristics of markets. Number one, liquidity. These markets, assets can quickly be sold or bought without affecting the price. Transparency, information here is free and accessible. Markets also are efficient, meaning prices will reflect all available information. In terms of depth, there are a large number of participants and orders in these markets. In terms of fairness, there's equal access and participation by all individuals that wish to engage in the market. So how is selling done without the secondary market? And what is liquidity? How is selling done without a secondary market? So if there's no secondary market, what happens? Without the secondary market, selling of stock would be inefficient. So you would need to find a buyer manually through personal networks. So this would take days and weeks. So the price you would get it might be lower than the stock price if it's true. Okay. So it is important to have what we call the secondary market. Then also liquidity. Liquidity refers to how easily assets can be converted into cash without any significant price drops. There are factors that will affect liquidity. Number one, active market participants. Number two, the narrow ask bids. Number three, the high trading volumes. These are factors that will affect. So examples of liquid assets are treasury bills. These ones are the most easily and stable in terms of price. So we also have illiquid assets. Illiquid assets are what? Assets that take time to sell. So we have um, real assets, real estate. That's an example of illiquid assets. Then we go to what we call secondary and primary market. Secondary and primary market. So what are secondary? What are primary markets? These are markets that are sold where securities are sold for the first time. And secondary markets are markets where securities are traded, like the New Lusaka Stock Exchange. So primary markets usually depend on secondary market for price recovery and liquidity. So investors buy in the primary markets knowing that they will resell in the secondary market. So we also have the concept of IPO and seasoned equity. What is an IPO? What is an IPO and what happens in there? What's an IPO? What is an IPO? So when dealing with an IPO, we are looking at an initial offering. Okay. We're looking at an initial public offer. So when you're dealing with an IPO, it refers to um, selling stock for the first time for a private company, usually when it comes into public. So they're traded on the stock exchange. So the process is often used by usually startups or private firms to raise capital for expansion. So example, Facebook in 2012, okay, their well-known IPO case. So when the social media giant went into public domain May 18, 2012. They raised close to about 16 billion US dollars. So this was one of the largest tech IPOs we had in history. Okay, the other component of IPO is the risk factor. So IPO usually involves having higher risk for investors due to lack of public operation in history. People don't know about it. So there's limited financial transparency, and people moving in these markets are usually joining based on underwriter reputation, not on the company itself. Then we also have what we call seasoned equity offering. Okay, seasoned equity offering. So SEO is also known as um, a follow-on offering, which occurs when a company that already traded in areas of shares is now just adding on. So it's often done to fund new projects or expand or reduce on debt. So Microsoft, we know they had in 2016 seasoned offerings where they had to sell additional shares. Okay, so the risk factor for SEOs is usually lower because issuing companies they have a record track. So the differences between these usual questions will ask you to differentiate between an IPO and seasoned shares. So you need to understand the differences between the two. So what is the difference between an IPO and a seasoned equity offering? So in terms of status, usually private companies that want to become public are the ones that issue an IPO. Here is an already public company. In terms of investor risk, is high for IPOs and lower for SEOs. In terms of disclosure, there's limited track record. Here there's full financial history. In terms of market reaction, um, it's often volatile. Okay. Are we together?
Yeah.
Then the use of the proceeds here, they're mainly for expansion and growth or debt repayment. Here, they just want to have additional funds to be added. Okay. So I'm trying to um, break in before I look at the exam questions. It's important that you understand these important terminologies that we're going to look at. So when we go to chapter 4, there was a concept of the key order types in securities. We've heard of the key order types. What are these key order types, and what do they entail? So the key order types are used in investment to explain concept of investment. So key order types in financial markets, understanding of the um, essential for executing trade or managing risk. Okay, so we have the following were what we call the market order, which is an instruction to buy or sell a security immediately at the best available current price. So this market order usually guarantees execution, but not at the exact price. So we also have um, a limit order. A limit order is an instruction to buy or sell at a specified price or better. Okay, so let's now look at some of the exam questions here. Let's look at the 20.
I'm sorry, I didn't get what the key order types are.
Okay. the key order types. What is your question?
I did not get your explanation on the key order type.
What are key order types? By definition, we say the key order types by definition. Um, we talked about the key order types in terms of the three. We have the market order. These are simply instructions, in short, to buy or sell securities. It's called a key order type. So we have what we call the market order type, where you instruct to buy or sell security immediately at the best available price. Okay, we also have a limit order, which is an instruction to buy or sell security at a specified price or better. So we talked about the four order types that you need to know. So these order types, if you don't know, you can't guess. They're about instructions that are given whenever you're buying a stock. So we have a limit order, which is an instruction to buy or sell security at a specified. Then we have a short sale. A short sale is a best act of selling borrowed shares. Then we have what we call a stop loss order, which is a present instruction to sell security once the price falls at a certain level. So we're trying to appreciate the use of what we call secondary markets. So secondary markets are markets that are used especially when you want to trade um, on already existing markets. Okay. So question number one, in 2021, the Black Mountain is a small-scale mining organization based on the Copper Belt. Its operations involve extraction of leftover copper deposits found in various mining dumps, okay, in major mining towns on the Copper Belt. It provides short-term contractual labor for more established mining houses. So BMMS is usually owned by its members who are ex-miners. Okay, so the company has been in operation for 7 years now. Last year, the board approved an outstanding recommendation to form a private pension for its members, and it's hoped that the coming of the pension will address the general lack of retirement and thus alpha plug the members. However, it is already clear that the significant lack of appreciation for the financial markets in general and investments in particular among the trustee appointed to manage the fund. As a result, management board has resolved to hire a consultant to provide financial markets with investment awareness and training of trustees who have been selected as a consultant, but want to explain the main components and objectives and procedure that is followed when you are making an investment. Okay, number two, you've been asked to describe the characteristics and the main players in investment process of the fund. Number four, advise the trustee on the typical securities to consider on the Zambian financial market for both short-term and long-term planning. So let's start with the first part. What are the main, uh, we're looking at this part here. What are the main contents and objectives, procedures that are followed when you're making an investment? Talked about these, those that remember. Whenever I make an investment, what are the main procedures that you should follow? Number one, Mr. Francis, me and what are the procedures when you want to make an investment? First, you need to set the investment objectives. So the investment objectives need to define what the purpose of the investment is. Is it capital appreciation, income generation, or risk management? So you determine the risk tolerance, whether you're risk averse or risk seeker, and the time horizon. So number one, you set the objectives. Number two, you need to conduct an investment planning. You evaluate the available financial resources and select appropriate investment strategy, whether it's conservative, balanced, or aggressive. The third step is to analyze the opportunities that are there, assess the market, assess the industry, and evaluate, okay, which we're going to go for. Then we need to select the investment instruments. We're going to choose from the asset classes. We have the financial and the real. So you need to choose what you're going to go in. Then you make the investment. So you execute a trade based on evaluating it. Then you monitor and review and adjust where possible. So these are the steps we talked about. So you make the investment, then you monitor and review, regularly track the performance, and conduct an evaluation and adjustment periodically to see the success of the investment. Is that clear?
Yes.
It is. So it's just like outlining components of the investment policy, yeah?
Yes, yes.
Okay.
Component of the investment policy. So the second part here, okay, discuss the characteristics of the main players in the investment process and the role of the fund in the process. Okay, what are the characteristics? What are the characteristics? What are the characteristics of the main players in the investment process? So who are the main players in the investment process? We talked about them in the previous class, about 10 of them. You can even remember any five. So we have the investors themselves. These are individuals or institutions like BMM's fund in this case, who provide capital with the expectation of a return. Their role is injecting capital in the various investments. Okay. Number two, the financial intermediaries, which could be the banks, the insurance companies, and the fund managers. These two serve as middlemen between the investors and the securities market. Okay. Their role mainly is to provide funds, the pooled funds, and offer advice. Other players, we have the investment advisors or consultants. These come as a professional body with expert knowledge in financial markets and portfolio management. Their role mainly is to guide investors like BMMS trustees in making informed decisions and setting strategies. Which other players do we think are important in this investment process? The regulatory bodies, the brokers, the the board of directors at BMMS. Okay, so the regulatory bodies in Zambia, like SEC or Bank of Zambia, and the Pensions Insurance Authority, their role is to ensure that there's transparency and to protect the interests of the investors and promote the integrity of the market. The stockbrokers here and dealers, these are licensed market participants who participate on behalf of their clients. They're like lawyers. They're only licensed people to participate in this market. Their role is to facilitate trade of securities. Okay. Then let's look at the role of the pension fund, the PMMS pension fund in this investment process. What is their role? These are the capital provider. So they accumulate contributions from the members to be invested. The institutional investor who act on behalf of the group, and he has a fiduciary responsibility to maximize the benefits of the members' retirement benefits. Okay, failure to which this body can be sued in their personal capacity. The long-term planner, these are the investments that can be diversified to provide portfolio for sustainable income. The government's role here, the trustees to oversee the investment process. Okay, then let's look at question number part C. So let's advise the trustees on the typical securities to consider on the Zambian financial markets for both short-term and long-term. What are some of the securities that can be considered? This we should on the short term. Short term is 1 year to 3. What short-term securities are we looking at? The treasury bills, the money market fund, the fixed deposits. All these are examples of security that can be traded in a period of 1 to 3 years, short term. Okay, so they're actually asking you to identify the short-term investment plans. So treasury bills usually are issued by the Bank of Zambia for 91 days to 364 days. So they have low risk and they're highly liquid. They are suitable for capital preservation because of the low risk. The other examples that you can advise a trust to look into are fixed deposits, which are usually offered by commercial banks. There's a guaranteed return as long as you invest them for the said period of time. The fixed deposits are also ideal when you want to earn interest. Okay, they kind of play a role like savings account. In the money markets are short term, which are offered by licensed asset managers who invest in short term securities. They offer daily liquidity. All right. So these are some of the short term. In the long term, more than 3 years, what securities would you advise um, the fund to look into? In short, you're being asked to identify what are long-term investment opportunities that one can consider. So we have government bonds, which take 2 to 15 years, and they'll provide you with semi-annual interest, which are considered risk-free. After years of maturity, you're given the initial investment. What other long-term investments can we look at? We have listed equities like shares, which can be traded on the Lusaka Stock Exchange, considering investing in companies like Zambeef, Airtel Zambia, Zambia Sugar, which offer capital appreciation and dividend income. You can also consider real estate investment, where you directly purchase property or build, which is suitable for protection and long-term income. Invest in pension or unit funds, which is professionally managed and diversified by experts in a pool of investment, ideal for trustees who lack time or expertise to manage a portfolio directly. Then you look at corporate bonds, which are issued by private companies and offer higher yields than government bonds, but they carry a higher risk. So these are some of the recommendations you can give the trustee or the fund to look into. Okay, so are we together? So what advice would you give the trustees basically is to adopt a balanced investment strategy, combine low short-term investments to high long-term so that you prioritize diversification. So you need to regularly review and adjust the portfolio based on the performances. If one is doing fine, continue. If one is not doing fine, you can go to another investment and advise them to invest in what? Financial literacy to build capacity among trustees so that they have effective decision making. Okay, so these the issues that will be looked at. Are we able to remember that? So you need to advise,
Yeah, eventually.
it's very clear. So you need to advise the firms on what to look into. So what has been the final advice to the trustees? Number one, adopt a what? A balanced investment strategy. Why? How? By combining short-term and long-term to see prioritize diversification to manage risk and review and adjust the portfolio based on performance, and also invest in financial literacy so that their decisions are made in the best interest of their clients. Is that clear? Okay, let's go to question number 2. I need you to participate, and this one is easy. Select any four short-term securities in the Zambian financial market and explain their investment characteristics. Then briefly explain why treasury bills are treated to be low risk. Anna, and short-term securities and their characteristics. I just mentioned them in the previous example.
Treasury bills.
Yes, treasury bills, correct. Or what are their characteristics? Treasury bills.
They're offered by the government. The tenure is, what's the tenure? The tenure is 91 to 364 days.
Yeah, below level risk. They have high liquidity and tradable in the secondary market. They are stable, ideal for capital appreciation. So they are issued by Bank of Zambia on behalf of government and are sold at a discount. Which other short term do we know of? Commercial paper. Can somebody tell me something about commercial paper?
Of 270 days. They're issued by reputable firms, backed by the banks, of course. They're riskier than treasury bills and therefore have higher return.
Okay. Yeah. So they're generally less liquid than treasury bills and can be traded in the secondary market. And held to maturity by most investors because commercial papers are designed to be a short-term investment. So investors may not always find a buyer before it matures. However, its liquidity is still relatively higher than long-term debt instruments, so it can quickly be converted into cash within its maturity period. And they're more stable in terms of stability. Commercial papers are stable and give higher yields, relatively short short-term duration investment. Then we go to what other short-term investments do we know of? Fixed deposit accounts. What do you know about fixed deposit accounts?
There are 3 to 12-month deposit instruments, but they incur penalties for early withdrawal.
So they are issued by commercial banks or financial institutions, and these institutions are regulated by government and ensure high degree of what safety for them to be reliable. Their tenure is between 30 to 12 months, 30 days, 12 months, and the investor can choose their term based on their financial need or goal. So they are longer tenure and they have a higher interest rate. So their return is often a fixed interest rate, which is agreed upon at the time of the deposit. Okay, their rate is often higher than the savings account, of course, and the risk level is considerably low when placed in regulated institutions. Well, the principal amount is guaranteed by the bank or institution, making it relatively safe. In terms of liquidity, it is limited. So with a fixed account, because the funds are locked until they mature, and you're given a penalty, like has been said, should you want to withdraw earlier. Suitable for conservative investors who are looking for predictable returns. So fixed deposits are low risk to medium-term deposits provided by commercial banks. What other investments are in short term? Money market funds. What did you say about money market funds? Money market funds. So money market funds, what are they?
Basically, CISR, collective, what do you call it? Instrument schemes where money is pooled from various sources or various investors in order to invest in a fund, in a short-term fund, so to speak.
Okay. So they're managed by licensed asset companies. Their tenure is not very fixed. Okay, they are open-ended mutual funds. This means that investors can buy or sell shares of the fund anytime without having to worry. Okay, so the return, usually money markets offer daily accrued interest. So the returns will vary slightly with market conditions. Of course, we know the returns are usually lower than those of equities for long term, but they're generally higher than the returns for traditional savings accounts. So the money market funds have a moderately low to moderate risk level. Okay, so these funds are in the short term, and in terms of liquidity, they offer high liquidity with withdrawals typically available within 1 to 3 working days. So they are money market funds are ideal for investors who seek for short-term access to funds while aiming for better returns than savings accounts. So money markets generally are low to moderate risk. They're open-ended mutual funds that invest in short-term and they have high-quality debt instruments. They offer daily accrual interest and make them suitable choice for investing where you want to seek for short-term access to finance. Okay, so we are still on question number 2, where we've been asked to identify any 4 short-term securities in the financial market in Zambia and their characteristics. Then, briefly, explain why treasury bills are treated as risk-free securities. Why are they treated as risk-free securities? Any reasons why treasury bills are treated as risk-free securities or Max? Give me any 4 reasons. Because there's government guarantee. Okay, there is government guarantee. They are backed by the faith and credit that the government will not default. Number 2, there is no credit risk since government is considered to be the most trustworthy borrower. So investors will assume negligible risk of not being paid. It may take long. Then also short-term maturity because the period is up to 1 year. So it minimizes exposure of interest, volatility, and market fluctuations. And they're highly liquid. They're actively traded in the secondary market and can easily be converted into cash without any significant loss. So these are the reasons why they're considered to be highly liquid. Okay, is that clear?
Yes.
Okay. Let's go to the third question. The question reads, consider a 12-month potential investment in two securities. Security one has expected return of 6% per annum, and that security two has 8% per annum. Standard deviation for security one is 9%, for two is 10%, risk-free 6%, and the correlation between the two is 0.4. Okay, which combination of the two securities will result in expected returns that exceed risk-free rate? Which combination of the two will result in expected returns that will exceed the risk-free rate? So to answer this, we need to identify the combination of the two securities. We need to calculate first the expected return for the portfolio that consists of the two securities. So let's apportion the weight for security one and the weight for security two. Okay, the two must add up to 1. Okay, so we can assume they're either equal. So what is the return for security one? What is the return for security one?
6%.
6%. So R1 is 6%. And what is R2?
8%.
8%. Okay. Then what is the risk-free rate?
6.5%.
6.5%. Yes, it's the data that we have from there. So it's 6%. So we want to find a combination where the expected return will exceed the risk-free rate. So we can need that the portfolio return for the two should be more than the risk-free rate. Okay, so the weight, what is the formula for the portfolio return? The formula for the portfolio expected return, 10 for the portfolio, is that weight 1 times the return 1 plus weight 2 times the return 2. Okay, so we are trying to look at the combination that will exceed the risk-free rate. So this one must be more than what? Our risk-free rate of what percent? Of 6.5%. Okay, let me use arbitrary figures. If we assuming that they have equal investment, would we still exceed the risk-free rate? So if you have 50% of return 1 and 50% of investment 2, are we going to get more than the risk-free rate of we're going to get more than the return of 6.5%? Calculate, what are you getting there? What are we getting? Are we together? Are you following what I'm trying to get to?
think we are
I
getting
don't
seven.
have calculator.
Okay. So the weight of investment one and the weight of investment two must add up to one. So I'm trying to use logical thinking before I calculate for you. So this one is giving us 3% plus this one is giving us 4%. Okay, which is 7%. It is more than what?
6.5.
6.5. So if we assume that we have equal what? We have equal investment, we're going to get a risk-free rate. But this is just analog thinking. So now we know that the weight one and weight two must add up to what? 100. So now I want to ask, what is the minimum weight that we must have for us to be more than the risk-free rate? So instead of putting 50% here, I'll just put weight one, okay, times the 6% here, okay. So if this is 60%, what is the next weight? 100 minus 60%, yeah. So I'll just do 1 minus weight 2, right? You understand that this is the remainder. Should be multiplied by what? 8%, right? Right together.
Yes.
So it should be greater than the risk-free rate. So I want to calculate what this W is all about. So this is what? 6W plus 8 times 1 is 8 times minus W times 8 is what? Minus 8W. Okay? Should be greater than what? The risk-free rate. So far we together?
Yes.
Okay. So we now evaluate. Okay? We now evaluate what is 6 minus 8? 6 minus 8? Negative 2, right? Then this risk-free rate is what? 6.5%. Okay, so this must be more than 6.5%. So 6 minus 8 is negative what? 2. Okay? Then this one goes aside. What is 6.5 minus 8? It's 1.5, right? Isn't it? So we divide both sides by negative 2. So what is 1.5 divided by 2? What are we getting? 0.75, right? So which combination, therefore, should exceed that? So we can say at least security 1 must be made up of less than 75% in order for the portfolio to exceed the risk-free rate. Okay? So when you divide by negative 2 by negative 2, according to our what? Mathematics, the sign will change because we're dividing by the negative. Okay, so here, here. So the sign will change at this point. So our weight, weight 1 must be what? Less than 70% for us to exceed what? To exceed a risk-free rate of 7.5%. Is that clear? Are you together?
Yes.
Then part B, they asked what portfolio volatility for each of the combinations identified in A. What is the portfolio volatility for each of the combinations in A? Okay. So we What else were we given? We're given,
The standard deviation.
so standard deviation for one. What was standard deviation for one? 9%. And what is standard deviation for two? 10%. All right. So 1% and 10%. Okay. So we will calculate the portfolio standard deviation. Who remembers the portfolio standard deviation? Portfolio standard deviation. So we're going to assume, and we've been given, what is the portfolio standard deviation? Weight 1, standard deviation 1, weight 2, standard deviation 2, plus, you remember this long formula? Weight 1, standard deviation 1, squared on each, plus weight 2, standard deviation 2, plus 2, uh, weight 1, standard deviation 1, weight 2, standard deviation 2, and correlation of 1 and 2. Remember, do you remember this formula? One and two. Okay. So we now need to calculate the portfolio standard deviation. Okay. So we're going to assume there's equal weight. All right. So we say that at least it should be there. So assuming that they have equal weight, what will be our portfolio standard deviation? So we're going to now calculate to input those figures there. So what is our standard deviation for each of those ones? Those are the figures that we have. So we assume weight 1 is 50%, weight 2 is 50%. So the 9% and 10%, when you put them in there, you calculate using this formula and you find your portfolio standard deviation. Okay, when you compute that properly, you're going to find 7.9%. Okay, so our portfolio standard deviation will be 7.9%. Now, what is the implication of that 7.9%? Substitute the values. And find out 7.9%. Okay, so you can also redo that on the assumption that the portfolio A, we said the weight of A, according to our answer, should be less than 75%. So meaning the maximum that portfolio 2 must have is 75%. So meaning we can redo that to calculate our portfolio standard deviation. So we'll calculate there. We're going to find that this one is giving us 8.6%. So you need to compare the two. The 7.9% when you have equal weights and the 8.64%. Okay, so from there, you can now see that the volatilities for different combinations calculated similarly will give you a range of about 7.9 to 8.6% based on what we calculated in part A. So we can therefore answer our question here, which is asking us to say what is the portfolio volatility for each combination in A above. Okay, so volatility will range between 7.9% to 8.6%. Is that clear? And the last question is that which of all the possible portfolios will rely on the efficient frontier? Which of all the portfolios will rely on the efficient frontier? So what is the efficient frontier? The efficient frontier basically looks at the set of portfolios that will provide the highest return given a level of risk, whether it is high or lowest risk. So portfolios usually rely on what we call the efficient frontier. These ones are considered to be optimal if they're on the frontier. They help us come up with what we call a risk trade-off.
What's back to work?
Okay, please mute yourselves. So based on that information, we can conclude as follows. Number one, if we're going to plot the data on the frontier, the expected returns against the portfolio volatility of all the combinations weight 1 and weight 2, where weight 1 is less than 25%, we need to identify the portfolios with the highest returns for each level of risk. So in practical terms, the portfolios that are lying on the frontier will be such that they will achieve the highest return and for a given level of risk, and also achieve a minimum for a given level of return. Okay, so questions still comes here to identify which of all the possible portfolios will lie on the efficient frontier. So when you do your evaluations properly, we will find that when we calculate the returns of the portfolios for weight 1 and weight 2, the portfolio with the highest return for each of the risk levels and the portfolio with the lowest risk for each of the returns will lie on the frontier. So the portfolios with higher weights on security 2 will generally provide higher returns, and the portfolio with a mix of 1 and 2 will give us a trade-off between risk and return. So in a nutshell, what we can say is that the efficient frontier will be represented by a balance of risk and return optimally. So trustees will need to choose using the frontier based on the risk tolerance. So there's no calculation for there, you just need to analyze that. Okay, we'll continue our revisions later on. We'll end here for now.